Thank you very much, Abby, and welcome to the finance panel. My name is Laurie Goodman, and I'm an Institute Fellow at the Urban Institute and founder of its Housing Finance Policy Center. I'm also on the Ivory Advisory Board and have been since its inception. It's a real honor to moderate this panel. When we think about traditional finance, what comes to mind are products like the traditional 30-year fixed-rate mortgage for single-family homes, or or institutional investment in multifamily rental portfolios. But these traditional instruments have failed to promote the building and delivery of affordable and attainable housing. Furthermore, they weren't really designed for evolving problems like climate change, innovative solutions like new construction methods, or breaking down barriers to equitable homeownership outside of public subsidy models. The three innovators here today are addressing these issues through cool new financial models and products. So what I'd like each of them to do is introduce themselves and spend 2 or 3 minutes describing their innovation. So Alisa, why don't we start with you?
Thank you, Laurie. My name is Alisa Valderrama. I am co-founder and CEO of FutureProof Technologies. We're building an AI native property insurance carrier that's focused on facilitating and stimulating investment in resilience at the property level. The way we got into this was essentially my background was in infrastructure project finance. I'm an attorney by background, and I saw how easy it was to make
You're
the
an
case.
attorney by background? I never would have guessed.
Okay.
Sorry.
That's okay. You never know. Yeah, I saw how easy it was in that context to convince private property owners to invest in decarbonization or energy efficiency based on future energy cost savings. But when it came to investment in resilience, that economic case was very hard to make. And it turns out it's in large part because property insurance companies didn't have the technology, and still by and large don't have the technology, to be able to account for those very granular property features in a way that's robust enough where a property insurance company could say to a property owner, if you make these changes to your property, here's how much your property insurance would go down. So we decided to take a crack at building a model that could do just that. We trained a model using AI on a bank of millions of insurance policy and claims data points. And we launched our first insurance products in August of 2024. So we've been writing both homeowners and commercial property insurance in the Southeast with a focus on Florida. And we made it through our first hurricane season with an extraordinarily strong track record and great loss ratio of 0.5%, which is over 100 times better than comparable carriers writing in that same region at the same time. So we're really excited about what comes next for us and delighted to be a part of this panel.
Well, great. Thank you we're glad to be here. I really enjoy hearing about all the different applications of AI because I'm from San Francisco and AI is currently the goose that's laying the golden egg there. And so I love hearing about like real world, practical, helpful things that AI can do. So I love what you're doing. So my name's Jan Lindenthal. I'm the Chief Investment Officer at the Housing Accelerator Fund, and we're a nonprofit community development finance institution based in the San Francisco Bay Area. And our kind of reason for being is to deploy capital in a way that catalyzes change in the way that affordable housing is financed and built. And the context that we're operating in, just to put some numbers to this, and Rebecca shared these numbers earlier this morning, is that as of right now in the state of California, we're short 440,000 homes. That's just today for the people that are already here. Just the Bay Area, thank you. 1 million plus statewide. 250,000 of those are affordable homes that are needed. So the need is great. And it takes over 7 years and costs $900,000 per unit to build one affordable home. So the people that are waiting for that affordable housing, they don't have 7 years. They need affordable housing today. So that's the fire in our belly. That's the reason that we get up every day to do what we do at the Housing Accelerator Fund, is to deploy our capital in a way that we can really change the system. And we have a number of programs that we deploy. to achieve that goal. One of which is our Industrialized Construction Catalyst Fund. And this is a special fund that's focused on financing projects, making low interest loans to developers who are deploying industrialized construction in their projects. And we see a tremendous promise with industrialized construction that to date, at least in California, is largely unrealized. But we think that it has the potential to address a lot of the frictions that we see in the affordable housing space. And addressing frictions is one of my new words too that we talked about this morning. So this Industrialized Construction Catalyst Fund, it's a $10 million pool of capital. We provide low interest loans to developers, and it enables them to be able to pull the team together they need to really execute that industrialized construction project with certainty and with efficiency. And so that's what we're really excited to talk about. It's a $10 million pool, as I mentioned, and to date, we've committed that full amount, and we'll finance over 400 homes through that pool.
Thank you, Devin.
Thanks for being here, and thanks again to the Ivory team for having us. I'm Devin Culbertson, VP of Innovative Finance for Grounded Solutions Network. We're about a 300 organization member network in 46 states. And what those member organizations have in common is that they're all looking at building portfolios of homes that are affordable, that have lasting affordability over the long term, and that build wealth and stability over time. And what they almost all of those would also report to you is that they are trying to grow their portfolios and are running up against the ability of the local government to provide cash subsidy to make up the difference. And so as their member organization, they came to us several years ago now and said, can you all think of a different channel to help us build our portfolios and deliver on the demonstrated demand in our communities for home ownership and affordability and wealth creation? And so fast forward a few years, what we created was the Homes of the Future Fund, which you saw on the video. But basically what we're looking at doing is acquiring existing portfolios of single family homes. Those are typically homes that are kind of the affordable supply in a lot of these communities currently, and are increasingly owned by investors at all scales, not just institutional investors, but have been aggregated into portfolios that are controlled by investors and are not available for home ownership. So we're acquiring those. They're currently rentals, and so we're keeping those as rentals in the near term. And over time, what we're doing is transitioning those into the affordable ownership portfolios of the local community organizations that are in each of those places. So that is a 5 to 10 year hold, depending on some of the incremental circumstances. But what that allows us to do is when we make that transition, we're transitioning that to permanent affordability. So that is a stock that will become not just affordable for that first owner and build wealth for that first owner, but over time, we'll continue to build wealth in those communities. And so we'll talk more about why that's relevant over time.
Well, thank you all very much for those very good descriptions. We all know that innovations in finance like these need to be scalable to widely influence and improve housing affordability. I'd like to ask each of you, what's keeping you from reaching full scale? What would need to change? Policy changes, partnership, more subsidy to have greater impact? And why don't we go down the line again?
Yeah, I mean, I think this is going to sound self-serving. We are a venture-backed startup, but ultimately what we need is more money. Because what we've been operating in as to date is not, in fact, a full insurance carrier. We've been operating as what's called a managing general agent, an MGA. Because we're a venture-backed startup, we couldn't go to market as a full stack carrier. You need to have a balance sheet, and that money just sits there. So investors don't like that. VC investors, that is. So we launched as an MGA, which is the way that many insurance carriers get started. Some of the tech ones you might have heard of in recent years were like Root, Lemonade, Hippo, those guys. So the MGA to carrier pathway is, pretty well known. So we've been operating as an MGA, which means that to date, what we've been able to do is work with other carriers and use our tech to help them do pricing, risk selection, portfolio management in catastrophe exposed geographies where insurance is very expensive or very hard to come by. But what we really need to do is actually take on that huge amount of investment capital, bring on our own balance sheet, and become a full stack carrier ourselves. And the reason for that is that as an MGA, it's a great way to enter the market as a venture-backed startup. It's a very lean way to get into property insurance and prove out the predictive power of our model. We did that. That's great. We can do it more. However, we have to wait around for carriers that want to work with us. And we're trying to launch in geographies where generally insurers have been exiting steadily for the past 5 or even 10 years. We're talking about markets in Texas, California, Florida. And so for us, we've been held back in terms of our progress by needing to rely on incumbent carriers to work with so we can use their balance sheet and their regulatory paper. So the next step for us is to actually raise the capital to become an insurance carrier ourselves, and then we can control our own destiny. We can launch the programs we want to launch in the locations we want to launch them. And crucially, we can also release much more dynamic and exciting insurance products into the market that leverage our technology more fully. And I'll just say one sentence about that. So to date, what we've been able to do is go to, again, areas where insurance is very expensive or hard to come by. We can use our technology to essentially go all the way to the coast in Florida, right anywhere in California, and we can find which properties are more resilient in those locales and offer those property owners lower cost insurance relative to what else they could find on the market. That's great. That's actually a fine business model, and we could scale to be a very successful company just doing that. But we want to do something more exciting also, which is to kind of really put our money where our mouth is and tell property owners, for example, here's what your insurance costs you today, given your property features. And if you were to make the following changes to your property, here's how much we can guarantee you your insurance premium would go down. And that is transformational. And it links back to the reason I wanted to start this company, which is it provides that economic data that property owners, be they a homeowner or a commercial property owner, they need to have that information so they know where and how to invest their scarce capital to improve their asset. And without the certainty of that insurance premium going down by a specified increment, people don't make the necessary investments in their property. So for us to do that kind of really next generation stuff, we need to become our own carrier. It's going to entail a lot of complexity that probably no one else in the entire property insurance market would have the tech to be able to confront. We have the tech, and so that's where we want to go.
Well, one follow-up question, in
Sure.
addition to capital, do you need to operate as an insurance company? Do you need state licenses in each of the states and all that? I mean, is it a huge regulatory hassle as well?
Yes, answer that very quickly. And the other thing we need, crucially, and this is where I get excited to talk about talk with housing developers and owners at scale, is we also need distribution partners. So in order to sell insurance, you need partners who can help you get the word out. And I think one thing I've learned at this conference is that there might be a massive opportunity for us to work with housing developers, people who are building new construction, making sure that construction is, LEED certified, resilient, you name it, energy efficient. Those are going to be properties that we can really offer competitive insurance rates to. So getting that distribution network set up with the whole range of stakeholders who have a vested interest in making properties more resilient, those are going to be natural partners for us as we distribute and scale.
Thank you. Jen, what about you on?
Yeah, I just wanted to say,
Simply-
sign me up. Because the certainty that you're talking about in the insurance space is critical in affordable housing. One of the things that we're seeing from our developer partners is that uncertainty around just insurance costs, let alone the other 10 items in their operating budget, is really impacts the overall feasibility of their projects. And that certainty, whether it's insurance or other aspects of the affordable housing development process, it's a massive decelerator at a moment when we need production of affordable homes. And this is where we see, and I think, Devin, you were talking about this earlier, where we think the promise of industrialized construction is bringing more predictability and more certainty into that construction process. We think it can cost less money and deliver homes faster. We think that's the real promise. But even if it doesn't, even if it's just cost neutral, the reduction of the frictions in the process and the addition of the certainty that it brings and the cost predictability is huge value in and of itself. So with that sort of like belief that we have at the Housing Accelerator Fund, what we see is the critical barriers to scaling. And if you had asked me 10 years ago, what's the biggest barrier to building affordable homes in California, I would have said the entitlement process. I would have said community opposition to affordable housing. That's just, in my experience, not the case today. The streamlining bills that we have passed, like mission accomplished. We have more affordable homes on the books that are dead in the water because they can't get financed. So it's that financing uncertainty that is really, really a critical barrier to scaling at a time when we need affordable homes more than ever. So through our industrialized construction catalyst fund, we can deploy capital to a developer in very early stage. So this is early pre-development capital, and it allows them to pull their development team together, their factory partner, their general contractor, their architect, and really drive towards, rather than a design and then what's it going to cost me, it's building to a budget. It is like, we are going to build this for $400,000 per unit, and now let's get everyone around the table to accomplish that, which is like, sounds crazy, but it's actually the opposite of how affordable housing usually gets done. So that ability to invest early and provide that cost predictability to developers then allows them to, start pulling their whole capital stack together in a way that's really critical to accelerating delivery. Another barrier that we're seeing is that there's a real misalignment of incentives between in the affordable housing space. So historically, affordable housing policies have been focused around affordability. The lowest, making the homes as affordable as possible, which is absolutely critical for sure. But there has been less focus on cost. And so what that has meant is that affordable homes get Christmas treed with all the other public benefits that we want to see. Labor requirements, green energy requirements, which are valuable and important, but they are expensive. Other types of requirements, public art requirements, I could go on and on. And those are all valuable public objectives, but cumulatively, they have just put a stranglehold on our ability to produce affordable homes. So we think a real change in policy that's needed is a focus at the state, local, regional level around prioritizing innovation and cost efficiency is going to be really critical to moving the needle. And then the final thing I wanted to say relative to scaling is in California, we don't have a mature industrialized construction industry. It's still very nascent. And so, and one of the challenges that that industry has had in California is it's like this vicious cycle. So because there isn't predictability in the housing market, modular factories can't build a predictable pipeline, and so they can't build a sustainable business. And that has really been a barrier. And so what we've seen in other countries, we've traveled to Sweden and Scotland and seen what a mature industrialized construction industry looks like. It's where the government has played a really critical role in that demand aggregation and really creating a platform from which a factory can really scale.
I'm thinking I have one follow-up question, and that's, you mentioned financing first. To what extent do you require subsidized financing or low-cost financing or below market rate financing in order to, for the fund to exist?
We were really fortunate that our initial 10 million was seeded by a little bit of funding from the CDFI fund, thank you, and from a grant from CZI, the Chan Zuckerberg Initiative. And then we matched that more than 1-to-1 with our balance sheet capital. But that has allowed us to provide these loans to developers at concessionary rates, which, we're very mindful of not creating a perverse incentive or a moral hazard, like, here's this cheap money, try this innovation. We really want to pair that with developers who are really committed to innovation and to trying and piloting, true cost-efficient approaches.
Thank you. And Devin, scaling
Yeah.
solutions.
Yeah. So for us, so scale really means two things. There's the obvious, it's really scale of impact. And so when we think about people who are priced out of the housing market, we think about rent burden renters, we think about the entire renter population that's subject to rent volatility and not building wealth. There's this enormous need that we're really trying to pursue aggressively. But it also means some operating and cost efficiencies that really enable our model to be more successful, be more efficient, provide better returns to investors, et cetera. And so we really think about how we scale into operating efficiencies with larger scale operating partners. We think about how larger pools of capital are typically priced better. And so how we sort of move from very, very small pieces of capital that come at a much higher cost to us and to our fund into better cost efficiency on the capital side. So that's kind of the scale curve that we're thinking about. And the way we think about walking that and kind of the first rungs in that ladder for us are a few things. One, sort of thinking about more nimble sort of programmatic national capital that really thinks about the work that we're doing across the country and is willing to be opportunistic and go some different places to see this work and be part of the early successes. The second piece is really building our network around kind of that mid-tier of capital. So we are never going to be the absolute most profitable thing in the market. There are other options out there for that. But we're really looking to build our network of folks who are in that mid-tier that want meaningful returns, but not absolute market maximum
Would you
returns.
sort of define that as that kind of 6 to 8%, or is that?
6 to 8, 8 to 10. I mean, right in that range. I mean, when we start to hear mid-teens and up, that's when our eyes start to water a little bit. But we think that there's in those high single digits, maybe even low teens are viable, and also really wanting to see meaningful impact for that. And so wanting to be able to track with clarity and quantitative rigor, so what that's creating in community over time, and not just over the term of their investment, but afterward, how that continues to grow and create benefits. And the third piece is really better municipal partnerships. We see the ability to issue bonds and tax-free bonds is one of the best sources of market rate capital out there. That if we think about the market as a spectrum, that's really the best price part of it. And those partners also are able to provide things like property tax incentives, things like that. So really creating better partnerships with some municipal partners that can help us ladder up over time.
Thanks very much. Now that we have an understanding of each of your businesses, I'd like to actually delve a little deeper on each of them. So why don't we start with Devin now? Why is Grounded Solutions the right group to lead the Homes for the Future Fund effort? What made you uniquely positioned to do so?
Yes, I think a lot of that goes back to the history I talked about with the 300 organizations that are our members that we support on an ongoing basis. And so there are a lot of entities in a national spectrum that can buy and own homes. We have seen that. We are seeing that. But what we're really focused on is not the what, but the why, and the trajectory to that exit that benefits community. And so we've brought a lot of folks in around us and our team to scaffold us and make our team stronger on the fund management side, on the reporting side, on the operating side. So we've got a strong partnership network. But for us, it's really critical to stay in that fund manager owner role so that we're really stewarding those toward the mission end that's critical in a way that we think we're uniquely suited to do.
Yeah, thank you. And that's actually one of the things that I found most striking about Grounded Solutions is how many partners you have, and that you stick very closely to your knitting, and you don't try to be all things to all people. You bring in partners who complete the effort.
Yeah, absolutely.
And so, Jan, now that you're 1 year in following the launch of the ICCF, what are some of the lessons learned that you'd lift up, and how have they informed refinements to the program to further incentivize industrialized construction?
The first one that I would mention is the value of being able to share best practices in real time. And Allie talked about this morning, and she called it shortening the feedback loop. So because of we're seeing a really large segment, believe it or not, with 4 projects, a really large segment of the affordable housing projects that are using modular in the Bay Area. So, and even those that we're not financing, we're staying very close to. So it's like learning on steroids right now for us. And then we're able to immediately be sharing that with our borrowers so that they can make those mid-course corrections in real time. And we're seeing real benefit from that already. The other is, and this was both like an immediate learning and a change to our program that we made was, and this is no surprise, but for conventional construction lenders, there is a perceived risk with modular construction, even though it's a shorter duration of construction And, there's just a whole lot about it that should reduce the risk, because so much of the cost of the project is concentrated in this one subcontractor, meaning the factory. There's more perceived risk by lenders. And so in the first project that we closed earlier this year, we left our funds in during construction. So we took a subordinate position to the senior construction lender, and that actually was really critical for them in telling their credit story within the bank, that to have our funds in the deal. And that's not how we always want to be able to do things. We want to get our money out and revolve it as quickly as possible. But we recognize that in order for lenders to get comfortable, we've got to have a few turns of the flywheel. And so that was a change that we made. And so now our funds not only go in during pre-development, but can stay in during construction if needed.
Thank you very much. And Alisa, can you talk about the need for new models in insurance? Why is the current model broken, and what changes do you envision in the industry writ large?
Very small scope of your question.
Yeah.
Okay, cool. I'm going to focus on something that I think everyone here can probably relate to, which is the fact that the entire property insurance industry really relies on, at present, a very coarse grid system for assessing risk. And that's very surprising to me, because before I came into insurance, I just assumed everything was very granular and, laser-like. But it turns out, alas, no. A lot of the underwriting decisions that are made throughout the insurance ecosystem, whether it's an insurance agent to an underwriter actually at a carrier, a reinsurer, you name it, they're often thinking about things on a zip code level. And that's highly problematic, because if you have two homes, for example, both of them, let's say, are in a zip code that's been deemed like high wildfire severity, for example. One of the homes is, basically the wildfire severity hazard zone nightmare home. It's, has a shake shingle roof. It's like surrounded by brittle, dry brush, and, has done everything wrong with respect to wildfire risk. Well, there's another home just down the road that's done everything right. It's like a bunker. This other home in the same zip code has, concrete construction, a metal roof. They have mesh on the soffit vents. There's like 100 feet of defensible space, which is beyond what you need. It's like the polar opposite of property A. Yet in insurance world, very often property A and property B are going to be lumped together in the same underwriting decision. An insurance company is going to look at that zip code, which is in a high wildfire severity zone, and if the exposure, the risk of loss is going to be too high for that whole zip code, they're just going to write nothing in the whole zip code. The whole zip code is going to be like crossed off the map for them. And that's a terrible problem, because A, it means that property owners don't have the right incentives to make their properties more resilient. The ones that do make those investments don't see often the benefit they deserve. And it's also good risk being left on the table by the industry, which in turn causes the industry to just wholly exit from large swaths of the country. So it's a big problem, and I think that is exactly the problem that we are taking on at FutureProof. By training a model using AI on all that policy and claims data, we don't have to be a slave to those kind of zip code level, very coarse risk assessments. We can write all the way to the coast in Florida. We can write in Sonoma County. We can, here in Salt Lake City, you guys have a bunch of perils. You have flood, I think you have earthquake, wildfire. You also have straight line wind. But the point is, we don't need to necessarily worry about what's categorically, which perils are important. We can actually look at a given property and say, okay, well, yes, this is a risky zone, but if this given property has done everything right, or even most things right, hopefully we'll be able to write an insurance policy for that property owner. And if others are writing in that same zone, we can probably win on price and offer a lower priced quote, because we're going to be able to account for all those property features in a way that is much more robust from a data science perspective than how the rest of the industry is doing it. And I think that needs to be the way forward for the industry, but it's also the case that the industry moves very, very slowly, and there are not, I would underscore that, there are not really any players that are doing that type of risk assessment and pricing that I'm describing at scale. Every insurance company that you all can name in this audience is basically pricing through a combination of either Excel models and CAT models combined with human subjective judgment, or just the plain model with, very little sort of adjustment for property features. So that's the world we're living in. But the good news is, I think there are a groundswell of new tech startups. Of course, we're one of them, but we're not the only one that are kind of taking advantage of this moment when there is a crisis in insurance, when rates have gone up double digits in many, many states throughout the country over the past couple of years. And they're saying, hey, wait a minute, we have AI. There's a massive need for better insurance pricing. Here's a good opportunity.
And we probably have time for one more quick question per person. So I'm going to sort of focus on what has this taught you? So Devin, let's start with you. What's your work on Homes for the Future Fund taught you about innovations in finance more broadly?
Innovations in finance more broadly. So I think that there's a way in which, and I was sort of getting at this with the scale piece already, but there's a way in which in our industry, community development finance, housing finance, we really think, one, about deals, and two, about pilots. And I think that we set ourselves up to walk a much harder path when we do it that way. I think the smaller things are going to be really hard to demonstrate the successes to move into bigger things. And when we think only about deals, we can only think about a certain window of time. And so I've talked to folks over the course of the day that are thinking in longer time horizons that are not finding the resources that they need because it's a mismatch for a deal-based system. And so I think there are some of the challenges in that structure. And so part of what we're looking at is how we can kind of reach a little further afield and learn lessons from other industries that hopefully we can use in our scaling path.
Thank you. And Jan, from the projects you financed to date, what are some of the best practices you've identified that are basically very critical to scaling industrialized construction?
I would say it starts with the team selection, having the right team around the table. As I mentioned earlier, the architect, the GC, the factory that have experience. It's been striking the number of modular projects we've looked at where the developer has pulled a team together and none of them have done it before. And it's like, it might be good to have at least someone on the team that's done this before. There's probably something they could teach you. And then along with that is really clear contractual relationships. So that really puts the risk where it belongs and where it can be best managed. And we think, generally speaking, and this isn't a hard and fast, but generally that means that the factory is a sub to the general contractor, not to the owner. So the general contractor is responsible for delivering those homes from the time they come off the factory line to when they get set and stitched together on site.
That's interesting. That's very interesting.
Yeah, and then there obviously with modular construction, you need a really clear and early focus on logistics. And there's a lot of discussion around it's got to be the right site and it's got to be the right project. But I tend to think that if you start with a real focus on the logistics and planning for that you can make it doesn't have to be a perfect rectangle and all studio apartments, for instance. So those would be the things I would lift up.
And Alisa, for those of us not working directly in insurance, what levers can others in the housing ecosystem pull to support climate resilience and adoption? Or actually, answer the question any way you want.
I think there are a lot of good resources out there. And to the extent that people who are developing housing, affordable or market rate, can kind of leverage those resources. I'm talking about, there's the IBHS, the Institute for Business and Home Safety. They have written extraordinarily comprehensive manuals for how to harden your home for a whole slate of perils. And, I think kind of consulting some of those guides in the same way that there's been such a strong uptake and adoption of standards like LEED and, other decarbonization efforts. I do think I'm sure there are standards for resilience as well, but I do think that for the reasons I described, the resilience stuff hasn't been taken up with the same gusto. And I do think it is because this economic price signal around the return on investment in resilience hasn't been there, but it's sort of a chicken and egg problem. And I think a lot of these organizations, again, like IBHS, try and make it their business to standardize, resiliency improvements. And I think to the extent that builders can kind of be attentive to that when they're building, maybe give us a call. We can provide lower cost insurance to your product when it's complete.
So so for each of you, are there additional voices or stakeholders that are needed at the table as we scale innovations in the housing finance industry? And Alisa, why don't we start with you?
So tricky. I think insurance in some ways suffers because there are so many competing interests that are so loud and difficult. I think insurance is very politicized. In some states, the insurance commissioner is an elected position, which causes some problems because, it makes it hard for carriers to raise rates even when levels of exposure go up. So it's a constant tension. Consumers, sometimes when they get their way too much, it ends up backfiring on them. And I think we saw that with California. Consumers really, made it their first priority to tell Commissioner Lara and his predecessor, we don't want our insurance rates to go up. But as a result of that, in part as a result of that, a lot of carriers can't get rate in
You would
California.
basically remove some of the stakeholders, namely.
I don't
or at
know
least ease up.
I
on
don't know what the answer is. I would say my position wouldn't be to remove the stakeholders. It would probably be to encourage every stakeholder to take a more holistic view of the whole ecosystem and what's going to make the whole ecosystem of insurability sustainable for the long term.
Jen?
So we were really fortunate to have the opportunity to travel to Sweden and Scotland with the Turner Center for Housing Innovation earlier this year to see what mature industrialized construction industries look like. And this is going to sound really naive or Pollyanna, but it was really striking to see what it took to make it work. In both Sweden and Scotland, it was a concerted, coordinated effort to get all the stakeholders around the table, stakeholders that might have competing interests. And there's nothing like that happening in the construction industry in California, not at all. I mean, this was developers, cities, factories, builders, the local government, all came together and said, how can we figure out not a zero-sum game to get to the lowest common denominator, but actually grow the pie? How can we agree on some principles and some goals to be able to scale this industry? And in both cases, in Sweden and Scotland, it started with leadership from the local government because that's the best way to get everyone to the table. But there was also a really concerted effort from industry as well, and so I really think that's what's needed, and that sounds big and overwhelming. And in both cases, it took years. So we got to start somewhere. Let's start now, and 5 years from now, we'll be in a much better place.
Thank you. And Devin, you have the last word.
Yeah, for me, I really think of the ingredient that I think about that could really change the recipe is the fixed income capital. And I think that there are a lot of folks that are thinking about how to guarantee those fixed income investors or how to get those allocators to think a little bit differently about what they have, how they've configured their investment sleeves. But I think that is the piece that, in some cases is driving a lot of SFR investment because they are able to take a very long view and not a kind of a deal-based approach. And so I think that if we, to the extent that we can sort of find a way to knit connections to that as that capital source and that fixed income, both pricing and term of investment, I think that really changes a lot of the things that we're trying to do for very long-term affordability in housing.
Thank you very much. I'd like to thank all three of our innovators for their drive and for their creativity and for sharing it with us today. Thank you all very much.